protecting Main Street from Wall Street. It's Chris Hoffman with Money Unleashed.
How much money do you put into your checking account from work on a month-to-month basis? It has a high probability that with your investable assets, we can replace that paycheck.
It's time to put you back in control of your money.
You've worked for 35 years. It's time for you to not stress. It's time for you to enjoy and live the retirement you want to live.
It's Money Unleashed with Chris Hoffman on WSB.
This is Money Unleashed with Chris Hoffman at the Hoffman Financial Group, proud partners of the Georgia Bulldogs. Hoffman Financial Group can be reached at 404-341-6767. You can also find us online at unleashyourmoney.com. For a while, we were talking about the forecasting of what these Federal Reserve rate cuts could mean, and now we get to do the responding to it, not the reacting, not the overreacting, but the responding to these. As the Federal Reserve announced this past Wednesday that it will lower interest rates by 0.5 percentage point or 50 basis points. Rather than dig into what I've been reading and what folks out there maybe have heard or seen, what do you believe the Fed accomplished with this cut, and where should we be expecting to see the impact both as consumers and, of course, as investors?
Yeah, so the two rate numbers that they were considering as far as the rate reduction were a 25 basis point or 0.25% lowering of interest rates or a 0.5% lowering of interest rate. And if everybody listened into me a few weeks ago, I was pounding my hand on the desk saying they absolutely need to rip the Band-Aid off and go a full 0.5%, which they did. The reason I said they needed to do that is I thought a 25 basis point lowering would have no effect on the economy, no effect on the labor market, no effect on borrowing. I think it would have just been dipping their toe in the water. So I compliment them on getting a little bit more aggressive and doing a 0.5%, and the market responded well.
Yeah.
It had a good day, I think, after that release. So what is this lowering of interest rates? What's the purpose of it? What is it supposed to do? What's the intended effect? Well, naturally, lower interest rates spurs borrowing, and corporations borrow a lot of money to, for R&D, for research, for expansion, et cetera. Could also help the labor market. And we've seen some softness in the labor market. So that could be kind of a boom for that side of the economy. If they maintain now a slow decline, another 25 basis points at the next meeting, et cetera, it could raise inflation. So that's the negative. Low interest rates cause a lot of borrowing, cause a lot of spending, and the price of goods and services may rise. So we have to watch the inflation uptick. And the third positive thing that it may do is it may improve corporate outlook for 2025. So corporations have been reporting earnings to a large extent. They've been very positive this year, but several major corporations have warned of a softening environment and a soft 2025. So I think this 50 basis point lowering may help, and we may see some positive outlook comments from major corporations. So now, the problem with lower interest rates isn't spurring the economic growth. The problem with lower interest rates is that it hurts retirees. And I've said it before, and I'll say it again. Shooting for a sub 2% inflation rate is not healthy for our retiring Americans. We want higher interest rates. I'll give everybody an example. I met with a client last week. We reviewed this entire portfolio, and we reviewed some changes we wanted to make and some adjustments in active portfolio management. Then we started talking about interest rates. And he said, I don't know if you remember this, Chris, but I used to be a broker back in the day. And there was a time when we had offerings to clients of 12 or 15%. So think about that for a minute, folks. Let's say inflation, and I didn't ask him what year it was, but maybe it was the 80s, right, when we had runaway inflation.
Significant time.
Yeah. But if you're in your 60s, how many 60-year-old families are borrowing massive amounts of money? You're not. The 20-year-olds are taking large mortgages. The 30-year-olds are taking large mortgages. When we get into our 50s, we're paying down our mortgages. When we're in our 60s, hopefully we don't have mortgages. We don't buy the shiny new car on a lease. We buy it 1 year old and it works and we're fine, right? We've scratched those itches in our 30s and 40s. So Inflation does not necessarily hurt retirees as much as it hurts the younger kind of middle-class Americans. I don't want runaway inflation for them either because they're spurring the economy. But I would like us to be able to get good fixed income products for our retirees. And this is a clear signal from the Fed and or the government that they do not want to award savers and non-borrowers. And we are a spender's nation. We borrow and we spend, and we borrow and we spend. Evidence of that is the national debt at $34 trillion. So all of that is a little bit alarming. So we are very conscious to look for ways of getting high interest paying products into our client portfolios. Now, some of them are affected by lower interest rates, but if we start high enough, those shouldn't slide down too far. That's it in a nutshell. The stock market right now has hit all-time highs, both on the Dow and the S&P, and the NASDAQ's not too far off of it, but it skyrocketed, so it just bounced down a little bit. But call the markets at all-time highs. I also, in front of that client, pulled up the 5-year S&P 500 chart, and it's up 90% in 5 years. Wow. So the days of people saying, I'm good with doubling my money every 10 years, now people's expectations is, I want to double my money every 5. And that can be an addictive type of thing to get hooked on that type of expectation. We want to take advantage of it when the market's going up. But you have to have proper protection, and you have to have a distribution plan for your assets when the market is going down. And that's the difference between working with a fiduciary team that specializes and focuses in on retirement versus just taking every client, regardless of age or size of portfolio, et cetera, et cetera, et cetera.
Now, staying on the subject of these interest rate cuts, and you brought up inflation, but CNBC senior analyst Ron Insana discussed what this rate cut signals in another way, and if it is actually a warning sign for something larger.
I think we need to look at this through a slightly different prism than trying to rescue a weak economy. The Fed is trying to normalize interest rates because inflation has fallen so much from its peak of 9.1% as measured by consumer prices down to the current 2.5% and likely to fall further. So that means that the Fed's got a lot of latitude here. The economy is in good shape, but the Fed is trying to, as we like to say in our business, stick the soft landing. It's something that many Federal Reserves in the past have failed to do, which is to raise interest rates, kill inflation, slow the economy, but not throw it into a recession.
Chris, you have seen how these types of cuts can affect the economy at large. You just mentioned some of that. And you also have mentioned in past shows that it's a reason to be alert, aware, and active, of course, in managing our financial lives and our financial matters. So I'm curious about the prism through which you're viewing this, to borrow that term from Mr. Insana.
Yeah, so inflation is reported by the government in several different ways, and you have to be careful. So from our perspective, we're looking out for individual families, and they are typically in their 50s, 60s, or 70s. And that's a different view than what obviously the Fed is trying to manage across everybody in the U.S. I get that, but we fight for the pre-retirees and the retirees. Those pre-retirees and retirees, we are not seeing inflation come down as much as it's being reported. Now, does that mean the government is lying to us? No, not. I mean, they are measuring it, I believe, accurately. But let me give you one example. The cost of food is up about 12%. And that is not coming down. Eggs are up 55%. And my wife said, if you want to buy organic milk, I think she said it was like $7 a gallon. Oof. Wasn't milk one of the cheapest things when we were growing up to buy? $1, $1.50, what have you? So some of the staples that we all need to live on are not coming down, and they can't be manipulated by these interest rates. At least we don't know at this point whether they will come down or not. But the other big concern that we have with inflation is healthcare, specifically later stage of life expenses on long-term care, home care, nursing care, et cetera, et cetera, et cetera. So we're looking very closely at what is going to be the impact, not this year and next year, but in 5 years, in 10 years, in 20 years, because I think I've seen almost every scenario of unexpected health declines. And it's tragic, and I grow very close to my clients. So to watch them go through these unexpected health events is stressful for them emotionally. We do not want it to be stressful for them financially. And that's where we are highly protective of our clients' futures. I look at retirement over a 30-year period, and I look at it in 10-year tranches. First 10 years, you've got to go out and travel and spoil your grandkids and enjoy your hobbies, because if you retire at 60 or in your 60s, that takes you into your 70s.
Yeah.
From your 70s to your 80s, you got to kind of measure, okay, how are we feeling? How are we physically? How's our health? If you're a married couple, are we both doing fine? And you can continue that travel and all the things you want to do. But the last 10 years, okay, now we need to build your portfolio to make sure you have no financial concerns and you can pay for everything to make your life extremely comfortable. And I'm just using 30 years as the average retirement time. But that's the way we break it down, regardless of what the Fed does, regardless of what the market does, because the market will go up and it will retreat. We need to be prepared for all scenarios, and these expenses can be prohibitive in living your best life in retirement. So we want to check all those boxes off for you.
And preparation and being proactive is how you do that. 404-341-6767 is the number to get started. If you've not considered some of these things, if you've just been kind of wondering what the effects of these rate cuts are, and it's important to put strategies in place to have that full financial plan that accounts for all of these things. And the Hoffman Financial Group is here to help you do that, to put that in place, and can do it on a complimentary basis. 404-341-6767 is that phone number. You can also go to unleashyourmoney.com. There's a nice box right there. You can click on Full Financial Plan and get started today. Chris Hoffman is an investment advisor representative of Retirement Wealth Advisors, Inc., an SEC-registered investment advisor. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosures of any conflicts of interest. Please refer to our firm brochure, the ADV2A, page 4, for additional information. The Hoffman Financial Group, Retirement Wealth Advisors, Inc., and WSB Radio are not affiliated. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. This information should not be considered tax or legal advice. Individuals should consult with a professional specializing in the field of tax, legal, accounting, or investments regarding the applicability of this information for their situation. Any client experiences discussed during the show are unique to that client. They are not meant to imply or suggest you will experience the same results. Past performance is not a guarantee of future results. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone. Hoffman Financial Group is not affiliated with or endorsed by the Social Security Administration or any other government agency. Investments will fluctuate and when redeemed may be worth more or less than when originally invested. Insurance licensed in Georgia, number 163546.